If you want to advertise on the internet, eventually you have to go through Google. It's kind of interesting because I'm on YouTube, and who owns YouTube but Google? Anyway, in the 1960s saw a big boom in conglomerates, and subsequently the overall consensus was that conglomerates did not quite carry the promise that they were supposed to carry. The idea again of conglomerates is that you own a company, the company owns many different businesses in different areas that are unrelated to each other. The problem is that the people running that company have to know how to run all these different businesses, and oftentimes they didn't. And furthermore, investors can diversify much more easily by buying completely different companies. We had a lot of business combinations in the 1980s, what were called leveraged buyouts. The idea here was that you could buy a company simply by borrowing a lot of money and then using that debt to buy the company. And oftentimes companies would buy competitors to this, or you had what were called corporate raiders. And if they felt that a company was not being well run, they would issue bonds at very high interest rate and use the proceeds of those bonds to buy the company. They would sell off some pieces of the company to pay down the debt a little bit, and then as they run the company, slowly pay down the debt. Some of these were wildly successful. Some of these were dangerously unsuccessful. But the history of the 1980s, if you watch the movie Wall Street by Oliver Stone, it gives you it operates in that environment and gives you some idea about how all of that worked. And 1990 saw even more mergers, especially in tech. And there was the level of regulation of mergers had been cut down in the 1980s and 90s, and that also encouraged a lot of mergers. There was a decline of mergers in the 2000s, and then we've seen a big increase in them. One of the things that happened with the downturn in the markets in around 2000, in the mid 2000s, was the government lifted its regulations. A lot of banking regulations were lifted, and previously investment banks had to be separate from consumer banks, so that companies that bought and sold stocks that were brokerage houses or in investment banks on Wall Street were usually not consumer banks. And what happened, and there was a difference between what were called commercial banks and personal banks. So you probably would not use a commercial bank to do your personal business. And what happened in the 2000s was that all of that became one, and government regulations were lifted. There was what was called a wall between the different kinds of businesses, which was removed. And one of the biggest ones was Bank of America acquiring Merrill Lynch. And until then, the idea that Merrill Lynch was a brokerage house, an investment bank, and Bank of America was a commercial bank. The idea that a commercial bank could own a brokerage was anathema to federal regulation until the early 2000s. And by the end of the second Bush administration in 2008, almost all of those restrictions had been lifted. And the result of that today is that there are massive banks that operate larger than have ever existed before. And a company like JP Morgan Chase, Wells Fargo, Bank of America is another example. These are larger than banks have ever been before. And the way to look at these is that you could look at them as horizontal integration, that in a way they were peers until a certain point, and now they operate as one. Now, one issue here is that subsidiaries can be used to manipulate earnings, and specifically we have what we call special entities that have done that. We're going to talk about this later on in the course. We're going to talk about something called special purpose entities. They say special entities here, but they're called special purpose entities. What you could do is you could create a subsidiary and hide all of your losses and debt in your subsidiary. And there's all sorts of creative acquisition accounting. It's usually pretty well regulated, and the way the standards have worked out today the accounting is much more straightforward than it's been in the past. We're going to talk about two kinds of expansion, internal and external. And the idea here is that a company can either create a subsidiary or it can buy one from the outside. So in an internal expansion, what a company would basically do is set up a subsidiary that will operate as a separate corporation. And it'll transfer assets. It'll set up a corporation, owning the stock to it, of course. And it'll transfer assets into the corporation and then, in turn, own the stock of that corporation. In an external expansion, what a company will do is identify a company it wishes to buy, approach the shareholders, and buy their stock. And in that way, P will own S. So let's first talk about the internal expansion. What you would do is here you would create a new business entity, and the simplest example would be simply a 100% owned subsidiary. What you could also have is you could have partnerships, joint ventures, special entities, all kinds of different things. In other words, it doesn't necessarily need to be structured in a way that the parent owns 100% of the sub. What a parent could do is it could join forces with another company and create a joint venture where each company owns 50% of this subsidiary. And that'd be called a joint venture. And by the way, most joint ventures, one company or the other has a little bit more, and they have the control. And these deals are always structured in this way. So what this would do is this would establish lines of control and allow you to keep the operations in this subsidiary separate from the parent. It also provides tax incentives, all sorts of regulations. The parent has legal protection from legal liability. In other words, legal liability is limited because whatever happens in that subsidiary is not going to directly affect the parent except for the value of their investment. And what could also be done is you could transfer assets into a subsidiary and then sell it to somebody else. You might be doing that just as a way of disposing of the subsidiary's assets. That could be what's called a spin-off or a split-off. And by a spin-off, that would be where the parent transfers assets into a subsidiary, and then it transfers the stock of that subsidiary to its own shareholders. So it'd be kind of like this. You have the parent creates the sub, and then the parent takes its stock in the sub and it gives it to its shareholders. So the shareholders now own stock in the parent, and they own stock in what used to be the sub. Here it's marked the sub, but it's not really a sub anymore because the parent doesn't control it. The parent shareholders might control it. And in fact, in some situations, you could argue that the parent has control of it, by the way, because if they're the same board of directors, then this is really like one company. But that's a side point. The main point here is that the parent created a sub, and then it took its stock in the subsidiary and gave it to its shareholders. So now the shareholders own two companies. They own the parent, and they own this second company, which used to be the sub. By a split-off, this would be a situation where the sub shares are exchanged for shares of the parent, and therefore some stockholders own the parent stock and some hold the subsidiary stock. So the way this would work again is that the parent has a subsidiary. I might have just created it last week. The parent approaches some stockholders and exchanges the parent stock for the subsidiary stock. So these stockholders previously held parent stock. They take back the parent stock and they give them the subsidiary stock instead. So some of the parent's shareholders own the stock in the parent, and some of the old parent shareholders now own the stock in the subsidiary. And this is really kind of like a divorce, because the two companies, the parent and the subsidiary, are now have different owners. And so in essence, they've really been split apart. So those are two examples of internal expansion. And if you're going to do a split off, then obviously it's not really an expansion. You're really becoming smaller. An external expansion would be a situation where the company is actually buying new assets from other companies, or it's buying another company entirely. So the way it's phrased here, entry into new product areas or geographic regions, acquiring, combining with other companies. A business combination occurs when an acquirer obtains control of one or more businesses, and control relates to the ability to direct policies and management. That's really what's key here. Control usually is going to occur when you own more than 50% of the stock of the subsidiary. But control can also occur when you have a situation where the parent has contractual, there are some kind of arrangements, and it can be formal or informal, but the reality is the parent really does have control of the subsidiary. So it could be not just, let's say you have, the parent only owns 50% of the stock, but there are 9 board members, and the parent has the ability to appoint 5 of them. And it could just be in the contract. There's some deal that was made that said the parent only owns 50% of the stock, but they have 5 people on the board, and so the other stockholder or stockholders only have 4 people on the board. In that case, they do have control because they can make decisions and so on. There are other situations we're going to talk about in future chapters that are very important to understand, and that would be situations where the parent really has all the risk. So the parent might own less than 50% of the stock, but the parent has all the risk associated with the investment, or has more than 50% of the risk associated with the investment, and therefore the parent, in essence, has control. FASB has never been able to catch up with this. The rules of this are, they've tried to create rules to explain this, and the FASB has never quite succeeded in doing it. And they're always in a game of catch-up where they're trying to catch up with what companies are really doing and create rules that'll work. Now, some of the terms that we use here are a little confusing. So one term that's used that's a little confusing is merger. And a merger would be a situation where the assets and liabilities of the subsidiary, whatever the acquired company is, are actually merged into one corporation. And that would be the technical definition of a merger. Now, a lot of times these terms are used loosely, and you may read that there's going to be a merger between 2 companies. Chances are it's not going to be this kind of merger where they're actually going to be one corporation. But a pure merger would be a situation where you take the assets and liabilities of 2 different companies and you combine them into a single company. Controlling ownership would be a situation where the acquired company is a separate corporation and the majority of its stock is owned by the parent. And therefore you have a parent-subsidiary relationship. And when you have controlling ownership, or the parent in essence controls the subsidiary, what's required is something called consolidation. And consolidation means that you would combine, even though they're 2 corporations, you would combine the financial statements as if they're one corporation. Non-controlling ownership would be a situation where the parent owns less than 50% of the stock of the sub. And more importantly, it doesn't really have control over the governance of the sub. So in essence, and it doesn't get more than 50% of the risk. So non-controlling ownership, you might buy 100 shares of a stock or something like that. You own 5%, 20% of the stock of the sub, and you're just there for the ride. You don't have any control over the company. That would be called non-controlling ownership. But there is what's called a beneficial interest. And that would mean that you have something like ownership, but you don't actually have ownership. So you may, for example, have you may be entitled to a percentage of share of profits, even though you don't own any stock. And that would be something called a beneficial interest. And this can be set up with contractual agreements. So a common way to obtain corporate control would be A, by purchasing more than 50% of an entity's non-voting preferred stock, B, bribing the CEO, C, playing a video game about that company, D, purchasing more than 50% of an entity's common stock, E, None of the above. And the difference between A and E is, A and D rather, is that here we're talking about common stock, and here we're talking about non-voting preferred stock. So the answer is D. Because non-voting preferred stock doesn't give you any kind of control. It's common stock that is going to give you the control.